We just finished going through Amkor Technologies FY2026 Q2 earnings call materials, and now we want to share our takeaways with everyone. Here's the question I kept chewing on late at night, and I think it's the one you're asking too. How does a company more than triple its EPS and then tell you profits go nowhere for 3 straight years? That's not a typo, and it isn't some bear's guess either. An analyst did that math out loud on the call, and the CEO answered, "Your math is right. So sit with me quietly for a while." Because the reason behind it is far more interesting than the headline. The company opens with the present, and honestly, it's about as clean a quarter as you will see. Revenue of $1.9 billion, up 60% year over year and 13% sequentially, according to the company. Operating income more than doubled year over year in the first half of fiscal 2026. EPS more than tripled over that same stretch. Then the company puts the reality check right next to it, which I genuinely respect. The analyst math shown here run the Q3 margin rate forward, and fiscal 2026 EPS lands near $2.50. And $2.50 is the company's own stated fiscal 2028 target. Hit your 3-year target this year, then flatline for 3 years. The page quotes CEO Kevin Angel with 3 words, "Your math is right." The company frames this as not an operational failure, but a calculated, multi-billion-dollar gamble on U.S. advanced packaging. And that gamble, the page says plainly, will consume near-term EPS growth. Our take is that this is the most honest slide in the whole deck, and everything after it is explanation. Before we go further, let me make sure you know what this company actually does for a living. Raw silicon comes out of a foundry like TSMC, and the company describes Amkor as what happens next: packaging, wiring, and testing for AI and EV chips. The finishing Carpenter, this page calls it, and I think that's exactly the right picture. On the advanced side, the company reports 2.5D packaging, which combines compute and high-speed memory for AI accelerators, currently running with 11 distinct clients. High-density fan-out, thinner and denser advanced routing is running 5 clients and 10 active projects. The company adds that a next-generation data center CPU ramped to maximum scale during Q2, and the Arizona facility, with Phase I under construction, is described as the future U.S. mainland base. The line across the bottom is the whole thesis compressed into one sentence. The company says Amkor is transitioning from a transactional OSAT vendor to a strategic infrastructure partner. Our read is that if that's true, the entire valuation framework for this stock changes, and if it isn't, nothing changes at all. Now here's the mechanic that made this quarter look magical. The company shows revenue grew 13% quarter over quarter, while gross profit grew 33%. Read those 2 numbers again because that gap is the entire story of this page. The company explains it once utilization crosses 70%, fixed costs are absorbed and marginal revenue converts almost entirely to net profit. Rent, depreciation, base labor, none of that moves whether the lines are running or sitting idle. The company reports Q2 utilization near 80% with several tech platforms fully maxed out. That's the elevator, and it lifted profit far faster than sales. But look closely at the phrase the company chose to include: "This lever is dual-directional." They did not have to write that sentence. They wrote it anyway. Because the same math that triples your profit on the way up will gut it on the way down. Our take is that operating leverage is not a moat. It's an amplifier, and amplifiers don't care which direction you're heading. So was this one hot corner of the business, or was it broad? Here's the data. The company reports computing up 20% quarter over quarter, a record high, with data center applications leading. Automotive and industrial up 17%, also a record high, with ADAS driving semiconductor content. Consumer up 15% on a broad-based IoT recovery. And communications up 6%, where iOS grew double digits but Android dropped 20% on memory constraints. 3 record segments in a single quarter. That is not one lucky customer. The company also shows mature nodes grew 21% in the first half, marking 5 consecutive quarters of year-over-year growth. And here's the annotation I would underline twice: moving from 50% to 80% utilization requires the entire product line to recover, not just AI. That matters far more than it sounds sitting on a slide. Our read is that the market is paying for the AI story here, while the legacy business quietly did about half the lifting. If that recovery keeps running, it's upside you are not currently being charged for. Now let's take that beautiful margin apart, because the company hands you the screwdriver itself. Q2 gross margin came in at 16.8%, an expansion of 250 basis points. The company attributes 2/3 of that gain to volume and utilization, and 1/3 to favorable product mix. Fine. But then there's the EPS reality check, flagged in amber by the company itself. A $21 million one-time real estate disposal gain sitting inside operating expenses. and a $14 million net one-time tax benefit, with the effective tax rate dropping to 14% against a 20% baseline. Neither of those is business. Both of them flatter the EPS line. To be fair, the company disclosed both clearly on the same page as all the good news. That is not how a promotional management team behaves, and I'll give them full credit for it. The company says the Q3 target of 18.5% to 19.5% relies entirely on product mix, with sustainability depending on compute continuing to outpace communications. Our take is simple: a margin built on mix is a margin that can unbuild itself the moment the mix shifts. This is the page that keeps me up, and it's only one seesaw. The company guides Q3 total revenue to a range of $195 to $2.05 billion. To get there, computing needs roughly 30% growth quarter over quarter, 30% in one quarter, on top of a record. The company says that's supported by 4 new 2.5D products and 4 HFO products launching in fiscal 2026. Everything else is either small or shrinking, with consumer up teens and auto and industrial up mid-single digits. And communications, the largest segment, is expected to decline high single digits sequentially. So the biggest piece walks backwards while the newest piece is asked to sprint. The page names its own risk. If data center CPU ramp ups delay, there is no backup engine to plug the gap. And next generation bridge technologies are firmly slated for fiscal 2028, which is a long time to wait for a second engine. Our take is that this guidance isn't wrong, it's fragile, and fragile is a very different kind of risk than wrong. Alright, now the part that genuinely moved me on this company. The company contrasts the historical OSAT model, quarterly procurement cycles and highly cyclical, with what it calls infrastructure lock-in. 2 contracts carry that entire claim. First, a 10-year advanced packaging agreement with TSMC, aligning TSMC Arizona wafers directly with Amkor. 10 years in a business that used to negotiate by the quarter. Second, a $1.5 billion advance payment from NVDA arriving in fiscal 2027, securing a 5 to 10-year capacity lock. Think about what a prepayment actually means, because it's the strongest signal on this page. The company's diagnostic reads that clients are no longer just buying services, they are proactively funding CapEx to guarantee future infrastructure. Management also confirmed similar long-term structures are securing Asian facility utilization. When your customer writes you a check years before delivery, that customer is not shopping around. Our read is that this is the single best reason to own this name, and it's also why the near-term pain might be worth enduring. Now the ugly page, and the company does not dress it up. The communications segment, the largest market, faces revenue headwinds across Q3 fiscal 2026, Q4, and the first half of fiscal 2027. The blame splits evenly, and that's where it gets interesting. Half is market factors, memory supply constraints altering customer build rhythms. The other half is self-inflicted, a strategic relocation of CP lines from Korea to Vietnam. Let me steam on that decision properly, because I think it's the right call. The company is vacating low-margin CP space in Korea to clear room for high-margin compute projects. That's a restaurant closing its busiest low-tip section to build a bigger kitchen for the dishes that actually make money. The page calls it a sound strategic trade, and I agree with that read. But it also calls the result a voluntary, prolonged revenue bleed in their largest market through the first half of fiscal 2027. Our take is that voluntary pain is still pain, and the market rarely gives you credit for it while it's happening. This page does something I wish more decks did, putting management's line right next to the underlying reality. Management said advanced packaging requires early intervention and long-term binding, pointing at the TSMC 10-year and NVIDIA multi-year deals. The translation given here true, but neither contract discloses near-term revenue. That $1.5 billion is a prepayment arriving in fiscal 2027, improving cash flow certainty but not immediate profit and loss. Management said the record utilization jump proves massive operating leverage. The translation: leverage is a two-way street, and unutilized depreciation from the new Arizona facility will compress margins in fiscal 2027 and 2028. Management said global capacity repositioning optimizes the footprint. The translation: of voluntary revenue void, with management openly admitting that headwind extends through the first half of fiscal 2027. Now notice what is not on this page. Nothing in that left column is a lie. Every single claim is true, and every single claim is missing the timing. Our take is that with this company, the question is almost never whether, it's when, and when is where the money gets made or lost. Here's how you actually judge a management team, and it isn't by the good news. This page scores where they held firm and where they ducked. On the margin bridge asked 5 times, management provided a hard quantifiable breakdown: 2/3 volume, 1/3 mix. On CP headwinds, Asked 3 times, management refused to minimize it as a single quarter issue and honestly extended the timeline into fiscal 2027. Think about how rare that is. Most teams would have called it transitory and moved on. On advanced packaging R&D, asked twice, they confirmed R&D stays within the historical 3 to 5% of CapEx guardrails. 3 questions, 3 straight answers. That's a good scorecard. Then there's the one they evaded, and the page labels it a complete evasion. Asked whether Q4 would see typical seasonal bumps, the CEO cited mixed dependency and refused to provide any numerical range. The page reads that as effectively denying standard seasonality. Our take is blunt: when a candid team suddenly goes quiet on one specific quarter, that quarter is the one to watch. And now the sole question, which is really why this whole video exists. Key banks calculation shown here assume Q4 margins hold flat with Q3 and fiscal 2026 EPS hits about $250. The stated corporate target for fiscal 2020 EPS is also $250. Same number, 3 years apart. And the CEO's answer on this page is those same 3 words: your math is right. The company's explanation is that Amkor is using its fiscal 2026 profit explosion to fund a long-term VIP pass into the U.S. manufacturing ecosystem. U.S. manufacturing burdens and unutilized Arizona depreciation is climbing while the factory ramps will devour near-term EPS growth. The page calls it the cost of evolution. And let me steelman that properly for a second. If you believe the destination, 3 flat years, is a price you pay, not a wound you suffer. I've been wrong on exactly this before, selling a company during its build year and watching it re-rate without me. Still, our read is that a plateau confirmed by the CEO himself is not a rumor you can argue with, and it lands squarely on your holding period. Follow the money, because a promise that size has to be funded from somewhere. The company shows CapEx running at $2.5 to $3 billion against aggregate liquidity of $3.6 billion. That liquidity comes from 3 places, starting with $1.5 billion from 0% convertible bonds issued in May 2026. Then the $1.5 billion VDA prepayment scheduled for fiscal 27 and $2.5 billion of current cash and short-term investments. On the spending side, 65 to 70% goes to facilities, heavily weighted toward Arizona Phase I. The remaining 30 to 35% goes to HDFO, testing, and advanced packaging equipment. Now the risk metric, and the company puts it right on the page rather than hiding it. Debt to EBITDA sits at 1.8 times, and that ratio is mathematically dependent on EBITDA continuing to grow. If fiscal 2027 profit flatlines while depreciation scales, the company says balance sheet pressure alters drastically, and security rests on management's own estimate that Phase I is fully subscribed. Our take is that fully subscribed is an estimate, not a signed revenue line, and that phrase is carrying an awful lot of weight. The company lists 3 risks, and I would rank them in exactly this order. First, the confirmed plateau margin compression across fiscal 2027 and 2028, confirmed by the CFO. Arizona depreciation ramps before utilization peaks, and the page stresses this is a stated mathematical reality, not a market rumor. Second, voluntary bleeding, the largest segment hampered until the first half of fiscal 2027 from memory constraints plus those self-inflicted line relocations. Third, single engine dependency. Short-term growth relies 100% on computing hitting that 30% sequential number, with bridge technologies not arriving to diversify until fiscal 2028. Notice that all 3 risks share one shape. They are timing risks, not existence risks. Nothing here says the strategy fails. Everything here says it outlasts your patience. Now the silver lining the company includes, and I think it's badly underrated, mature node utilization, especially at the Philippines facility, offers a free upside call option if legacy sectors keep their 5-quarter recovery going. Our take is that if you own this name, that legacy recovery is the thing quietly working for you, while everybody argues about AI. The company closes with the shift it wants you to accept, and one line carries the whole thing. Depreciation is the bill for this upgrade, not a symptom of operational failure. From OASET, passive, cyclical, quarterly contracts and a low multiple, to infrastructure provider, with 10-year locks, client-funded CapEx and a high barrier. That's a re-rating argument, and it is a legitimate one. Then AKPIs, and this is your homework. Does Q3 compute hit the 30% target? Does the CP relocation finish by fiscal 2027 Q2? Does the network hold above 70% utilization? And are margins driven by volume or just by mix? Then, when do Arizona Phase I commitments convert into actual revenue? Does the $1.5 billion from NVIDIA arrive on schedule? Does CapEx stay strictly inside $2.5 to $3.0 billion? And do the Philippine facilities fill their idle capacity? 8 questions, and the first 4 get answered inside a single quarter. Alright, last thing, radar always leaves you a light. I'm calling this one red, and let me be careful about what red means here. It does not mean bad. The business is getting structurally better, and those TSMC and NVIDIA locks are real. It means that at this point in the cycle, right after a record quarter, you are being asked to pay for 3 years of flat EPS. The CEO confirmed the plateau himself. The depreciation bill arrives before the revenue does, and the entire near-term forecast rests on one engine. I'm about 60% on this, which means I am genuinely open to being wrong. Here's what turns it yellow. Compute clears that 30% quarter, and communications bottoms on schedule by fiscal 2027 Q2. And it goes green when Arizona Phase I commitments start showing up as actual revenue instead of estimates. If that happens sooner than I expect, I'll say so plainly, and I'm telling you that up front. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.